Wealth Nation, today is the day, and we are going to get many of your tax questions answered. And you know who's going to answer them? Not Darius and I. No, not today. You are in for a special treat, my friends. We are speaking with the Tom Wheelwright. Oh my God, family, the God in my definition of taxes, of wealth management, of just breaking it down so this can be so simple and digestible for you. So Tom, thank you for gracing us with your presence, sir.
Well, thank you. Thanks for having me. And thanks for what you're doing, because I think that financial education is such an important message that doesn't get out in the general public, except through things like your podcast. So I think this is great.
Thank you. Thank you so much, Tom. One thing that I have to say, so a funny kind of joke in our household. So my husband has a beautiful brain for numbers and just understanding, complex equations, and I'm more high level overview. So when he saw this on my nightstand, he was like, "What are you doing?" Like, "What are you doing?" And so I was like, "You know what? I know I got to get this. I got to get these tax situations down. I just got to get it." And I have to say, Tom, like how you break down understanding taxes and just basic finances in general, you make it so relatable and accessible to those who may feel that it's beyond them. So I just want to thank you from the bottom of my heart for making this understandable and making it entertaining. Like, this is a page turner. Like, it should have been a romance novel in my head, because I was just like, oh my God, what's going to happen next? What's going to happen next? So today, I hope that we can at least get through all of the questions that we have in part one, because there's just so much good stuff.
Right. And it for me, it starts like by the time you get to page 5, where you mentioned that taxes is more of a guide than anything, than a rule follower, because 95% of it is about the guide on how to manage your funds. Mm-hmm. And the idea behind it. But we're going to ask you some questions.
I love this. You just keep going. You're doing great.
Awesome. So the very first question we have for you, one of our amazing clients, his name is Fernando, and he wanted us to ask you personally, what is your tax strategy for the average Joe so that he can save on taxes? And I know that you discuss this a lot in the book, but it'd be nice to know your overall answer.
I do. And I think that I can break it down to 3 questions. Okay. The first question you have to ask is, how do you make your money? Because how you make your money impacts how much tax you pay. Actually, different people, different types of income are taxed at different rates. Like capital gains are taxed at a lower rate, right, than ordinary income. And ordinary income is taxed at a lower rate than earned income. So the first question you really have to kind of focus on is, how do you make your money? So on that question, change how you make your money if you want a lower tax rate. Okay. So that's one way to do it. The second question I think is way more important, and very few people address the second question, which is, what are you going to do with your money? Because what you do with your money actually has a much bigger impact on your taxes. So how you make your money, I call that tax efficiency. So you pay less tax on the money you earn. That's tax efficient. So if you heard, for example, a financial planner say, we're going to be tax efficient, they're just trying to reduce the amount of taxes you pay on your investments. Mm-hmm. Mm-hmm. Tax effective is different. Tax effective actually means that you can actually create a negative tax rate, meaning you can get money back from the government. So on the other money you earned. So not only do you pay less tax on the money you're earning from the investment, but because of the investment, you're paying less tax on money you're earning somewhere else. Mm-hmm. So I actually start with those 2 questions. And until you can answer those 2 questions, I mean, you're stuck.
Oh, see, it's simple. It's just simple. It doesn't have to be complicated. So thank you for answering that.
Right. And I'm going to try to ask a question without the statement, but with the Kiyosaki's cash flow quadrant, where we have on the left side of the quadrant, we have people that basically W-2 employees, ENS is self-employed. Then on the other side, we have the business owners and the investors. What's the difference in mindset between those 2 taxpayers that puts them in those 2 quadrants? I mean, 2 sections. What's the biggest thing?
Well, you can actually pull this back to the first 2 questions. Mm-hmm. I think the biggest difference is that the people on the left tend to be consumers and the people on the right tend to be producers. And I actually think it's that simple. The government rewards producers with tax benefits, and producers meaning, so the big business, what they're doing is they're creating jobs, they're creating technology, they're producing, really a highly leveraged amount, right? And the investors, they're creating housing, they're creating, they're building housing for other people, not just themselves. They're growing food, right?
Mm-hmm.
They're creating energy, they're producing energy. So the people on the right side of the quadrant always pay less tax. But part of that is just the mindset. So here's what's great about the tax law in the US. We have in the Constitution what's called the Equal Protection Clause, which means that you cannot tax two people in the same situation differently. It's illegal under the Constitution. So that means that the small business owner can get all the benefits of the big business owner if they behave like the big business owner. So that's, the S quadrant is simply, as Robert might say, as you know, Robert's a good friend of mine. Robert might say it's a small mindset. It's not just a small business, it's a small mindset. Mm-hmm. And they're thinking like a small person. So people on the left side of the quadrant, for example, tend to do it themselves, right? I think do it yourself are the three most expensive words in the English language. And that's what people on the left side of the quadrant do. People on the right side of the quadrant, they know they're not going to get where they need to be without a team. So they don't do anything themselves. They're like, as Dan Sullivan would say, it's about the who, not the how.
Yes.
Yeah. Right. The people on the left, it's the how. People on the right, it's the who.
Mm-hmm. Yes. All of that.
Perfect.
So good. We continue to have this conversation with our audience of just mindset, right? That's the biggest thing. And I think you broke it down so simply is consumers and producers. And that's exactly what it is. And Darius and I, we just recognize as we continue to study the cash flow quadrant, for example, since we're talking about it, just the opportunity that we have to create opportunities. Yeah. It's like once you tap into that mindset of like, oh, I can produce and I can create and use, my God-given talents or, however you believe it, it's just all about recognizing the value that you're putting into the world and how to get on that right side of the quadrant.
Well, yeah, a good example of that. So some of my favorite books are children's books. I have grandchildren, so I read a lot of children's books. And one of them is by Yamada, and it's called "What Do You Do with a Problem?" And what the child finds out is that inside his problem is an opportunity. Mm-hmm. And I think that's your mindset, right? Is it like taxes? Are they a problem or are they an opportunity? And really tax-free wealth, the whole point of it is taxes are an opportunity. Yeah, they can be a problem for you if that's how you see them, but they're just going to hang over your head. And you're going to be like Mark Cuban, who said, well, the American dream is to get rich and pay high taxes. I'm going, nobody's dream is to pay high taxes. Maybe yours, but nobody else's dream is to pay high taxes, right? The American dream is to be financially free. That's the American dream. Right. And that's a mindset. So it's just a different mindset. Is it a problem? Is the problem a problem, or is there that opportunity inside that problem?
Always. There's always a light at the end of the tunnel. Yes, absolutely. And I have to say too, Tom, like you're the only person that has helped me shift my mindset in seeing the opportunity instead of the problem. Right. Because before the mindset was just, oh, this dreaded thing called taxes. And you've laid it out so beautifully where it's like, no, it's an opportunity and it becomes a game. Now it becomes fun and figuring out where do we Tetris and where do we move the pieces. So I just have to thank you again for what you've helped me understand, because with what we have with our platform, I recognize that we have a huge responsibility to make sure we communicate, financial education, literacy, whatever you want to call it, in a way where it makes sense to people. Mm-hmm. And so I just think you do that so well. So thank you for helping me reconnect with our audience in a way where I can hopefully, not that I'm talking about taxes because I'm not certified by any means, but we know where we can send someone. Yeah. I have more vocabulary is what I'm trying to say, more vocabulary to the conversation.
Right. Now, interestingly enough, our journey started a couple years ago where we got our first tax bill of 6 figures. And that put us on a trajectory to where we are now to be in front of you with tax-free wealth. Because there's something that happens mentally where, instead of that being a problem, it was an opportunity. of looking at us being just a few years off from having a 100K income to having a 100K tax bill. That's a huge difference in mindset. Now, when we talk about on page 48, your graphic of the average taxpayer versus the super taxpayer,
Sure.
There's just a small little switch that we need to make. It looks simple on the graph, but mentally, what is the dynamic around switching around how we go from an average taxpayer to a super taxpayer?
Well, so the concept's pretty simple. The typical taxpayer, so an employee, right?
Mm-hmm.
That's your average taxpayer. They pay for everything after tax. In other words, they have to pay tax first before they buy dinner. They pay tax first before they go on a trip. They pay tax first before they buy a car. So they're actually, so if they're in a 30% tax bracket, it takes them $1 for every 70 cents they spend. They have to earn $1 to spend 70 cents. The super taxpayer actually pays for things before tax. So that means that if they earn $1, they have $1 to spend. But the super taxpayer is almost always the business owner or professional investor. Those are they're the only people who qualify, right? Employees by themselves. This is why I say, if you don't have a business, get a business, start a business. That was what you guys did, right?
That's where I was going next.
You start a business. So that is, business is the number one tax advantaged investment throughout the world. It's not just the US. In my second book, The Win-Win Wealth Strategy, I actually do charts and tables on 15 countries. And I go through on business, like every country has all the benefits because business is universal. Governments support business.
Mm-hmm.
Perfect.
Phenomenal. And you know what? That segues into basically page 71. I told you we're all over this thing. So where we talk about deductions. So
I cannot tell you what these pages are.
We can tell you.
Yeah, exactly. We're studying this thing like the Bible. So
we've been studying it as a team.
Yeah. Our team is reading this, and the month of October, just so you know, Tom, our coaching students, the challenge is to read your book, and we're going to sit down and have conversations about this. So we're bringing it. We're bringing the heat.
I love it.
So as we shift to the super taxpayer, right? Would you say that is because we get to take advantage of the deductions?
Right.
And having an LLC.
Mm-hmm.
Well, what happens is with the super taxpayer, what they're doing is that they're actually, now here's what I think is some of the magic of the tax law, because I don't think it's just a roadmap for reducing taxes. I think it's actually a roadmap for building wealth. I think it is actually the best guide, the best wealth building guide on the planet. So the good example is what you're talking about here. If you're in business and you spend money, you have an expense, your goal spending that money is to make more money. That is your goal of that. That is the reason that you get a tax deduction for it. Because what the government's saying is, look, if you put your money into your business and your goal and intention is to make more money, well, in the end, the government's going, we're going to make more money. Now, it may take 20 years like it did with Amazon and it did with Tesla. It took 20 years, but the government's doing just fine now on that investment into Amazon and Tesla, which basically the government invested in Amazon and Tesla because of those tax benefits.
Totally.
Perfect.
I love that. And with the tax benefits, so going back to like the conversation of benefits, so deductions being one of them, what would you say is like the misunderstanding that business owners or anyone has about deductions?
I think the biggest mistake people make is they ask if something's deductible. And I think that's a terrible question. I think,
tell them, Tom, tell them.
I think there's a much better question, and that is, how do I make it deductible?
Ooh, Tom.
So I get this question. All right, okay, I've got this mug. Is this mug deductible? And my answer is, I have no idea if it's deductible to you. It's deductible for me, and I can tell you how to make it deductible for you. But you ask a better question, you get a better answer.
Right.
I have to, if Wealth Nation, rewind and make sure you just heard what Tom said, because we heard you say this in person at Caleb Williams' event. Shout out to Caleb. And you said it and it just shifted my mind. Like you were just saying, we have to ask better questions. Yep. Right. We can't continue to be so vague. And again, a lot of that just goes to our level of understanding and our education. However, hopefully with this video, right, we help you guys ask better questions so that you can have more deductions or whatever it is that you're trying to do.
You know, it's very much a mindset difference between your employee and your entrepreneur. I've never met an entrepreneur who wanted to know what he or she couldn't do. Mm-hmm. What am I not allowed to? No entrepreneur wants to know that. Mm-hmm. All entrepreneurs want to know, how do I do what I want to do? Mm-hmm. That's their question. That is the entrepreneur question. And so the mind shift is really employee mindset to entrepreneur mindset, because the entrepreneur mindset is going to ask the true entrepreneur mindset. The small business owner is going to ask, is it deductible? The entrepreneur is going to ask, well, so how do I make this deductible? And my clients are all entrepreneurs. I actually won't take a business owner. I only take entrepreneurs. Mm-hmm. And the difference in core, again, is they're going to think differently. Some of my clients challenge me the most because they're asking me, well, I read this and how do I do this? And how do I've got a client that I meet with every month, and he has constantly challenged me. And I learn new things all the time because he challenges me. That's an entrepreneur.
Mm-hmm.
Mm-hmm. Totally agree.
Now, another thing that I came across in your book, and it wasn't the first time I've heard it, but the first time I actually took action, is I added our daughter to our payroll. And just that, again,
she's 4. She's going to be busy.
4. Yeah, she's a advertising and marketing department.
That's awesome.
So with your children, you're able to pay your children a salary, which is up to that, $11,600.
Okay, so I'm going to shift a little mindset here.
Okay. Oh, here we go.
If that's okay.
Please. Come on.
Okay, so the first thing is to recognize, what are we trying to do? Mm-hmm. We're trying to take advantage of the way the U.S. and most countries work is that we have a graduated tax system, meaning that the more income you earn, the higher tax rate you pay on that additional income. Mm-hmm. When you have that progressive tax rate system, yes, the last dollar you earn is taxed at the highest rate, but the first dollar you deduct is deducted at the highest rate. And so it's the reverse thinking here. Mm-hmm. So people are always worried, well, I get a raise, it's going to put me into higher tax bracket. Well, only for that money that is in the higher tax bracket, not the whole thing, just the money that's in the higher tax bracket. On the other hand, you go, well, wait a minute. I have children, and my children have an asset, and that asset's a tax asset. There are lots of tax assets. Tax brackets are tax assets. And for example, a capital loss carryover, that's a tax asset. Okay, that's another tax asset. But your children have their own tax brackets. Well, it starts at zero. The first $14,000 is taxed at zero. Well, the next amount is taxed at 10%, 12%, 20%. So, you might pay your children $40,000. If they're worth $40,000, they're still, that $40,000 is going to be in a lower tax bracket than your tax bracket if you're in a 37% tax bracket. So it's not that you're not maxing out. Where you max out is what's your child worth, mm-hmm. right? In the work they're doing. You can't pay them more than the market. Mm-hmm. You would pay somebody else in the market. You can't, I mean, you can pay them on the high end of the market, but you can't get outside the market. So you can't, pay your 2-year-old for bookkeeping because your 2-year-old can't do bookkeeping.
Right.
Now you could pay them maybe as a model for your business, if that makes sense for your business, mm-hmm. right? That I'm going to include that. But they have to actually be doing the work. So if you're like, I had a client whose 8-year-old did his bookkeeping. She really did. I mean, she's actually on Wall Street now, but she did his bookkeeping and for his investments. And he wanted her to learn bookkeeping at 8 years old. She did. Well, he could pay her the same amount he would pay any other bookkeeper to do that, right? So it wouldn't necessarily be, the 14,000. I mean, if she did a lot of work, it could have been 20 or 30,000. While the first, 14,000 is tax free to them, above that is taxed at a low rate too. So there's not there's the limit is really what are they worth, and what's your tax bracket versus their tax bracket? Because what you're trying to do is you're trying to take your tax bracket, which is higher, to their tax bracket, which is lower. There might come a point in your life where she's making more than you are. Then it's not a good thing to do. Then she wants to pay you.
There we go. There we go.
I love that.
Now, something to look forward to.
Yeah, exactly. Well, and that's the perfect segue. Were you going to add?
Well, I was, since we're in chapter 9, I was going to ask about parents.
Yeah. Same thing.
It's the same thing, but it's the first time I've been able to read and conceptualize having our parents on payroll for the same purposes.
Well, I will tell you, actually, there's actually better ways to do it with your parents. If you pay your parents, their Social Security tax, right? Employment taxes. You can get away from that with your small children. By the way, you can actually set yourself up so they don't have Social Security tax, but parents, you can't. Okay. However, parents can have unearned income, not just earned income. Children, minor children, they have to actually have earned it. Okay. It has to be earned income for them to get their tax bracket. If it's unearned, they're in your tax bracket. So with parents though, that's not true. So your parents could actually own part of your business. They don't have to do anything. You can just give them part of your business and you can shift income into their bracket. And if you set it up right, they don't actually have to get anything. It's just on paper. So you don't actually have to distribute it to them. So one of the goals here is I want to own nothing and control everything.
There it is.
So that includes, if I've got elderly parents, for example, that I'm supporting, why not support them in their tax bracket instead of in my tax bracket?
Right. Because, we're building a business so our daughter can do this for us. We want to be her parents in the tax bracket that owns a part of the business that she's sending us unearned income. Well,
what's also cool about this is because, okay, so let's say you pay your daughter $10,000 a year. Let's say you can justify that. Okay. So you're paying her $10,000 a year. She's 4. That means that by the time, and let's say she takes that 10,000 and she does one of two things. I can think of a couple of things. She could put it into a Roth IRA. She could put it into real estate, or actually she could put it into a life insurance policy, a whole life insurance policy. And then when she's in college, she has full access to that money to go to college, and she has no restrictions on it. 100%. So even in a Roth, after 5 years, she can pull out the amount she put in. So that means in let's say 15 years, she could put in 150,000, pull it out completely tax-free, and all the earnings stay in the Roth. So there's all sorts of things you can do. I always think, okay, it's great to get the deduction, but what can I do next? Yeah, what's the next thing I can do that makes that deduction even better?
Yeah, leveling up. It doesn't just stop, right? So it's just like, here's the 101, here's the 201. I love that. Yeah. So it's the mindset. You continue to challenge, right? We don't just sit back. So thank you for that. You had mentioned before about like benefits. We talked about deductions. So tax credits. One thing that I learned from this book was, like you were literally saying, just use the tax code to be the breadcrumbs to lead you into understanding where you need to invest. And that was the biggest thing for me, because it's funny, Darius and I have a YouTube video we can share. We have a YouTube video where we were discussing, do we buy a gas car or an electric car? And we went with the gas car. And now after reading your book, I'm like, damn it, we should have bought the electric car. But if you wouldn't mind explaining, some of the benefits and tax credits and things of that nature.
Well, first of all, since we've talked about deductions before, let's talk about the difference between deduction and credit, because that's a very important distinction to make.
Thank you.
So we're taxed on our net income. That's net after our deductions, right? So if we make $200,000 and we have $50,000 of deductions, that means we're taxed on $150,000. Now, let's say that tax is $10,000. Okay. If we get a credit, that's dollar for dollar. So let's say we had a $10,000 credit, that could actually offset $10,000 of tax. So credits are way better than deductions. It's just simple. Credits are just way better. If you have a choice, take the credit. Don't take the deduction. If they're the same, just because it's so much better. Because also credit doesn't have is not impacted by your tax bracket, right? A deduction is worth more if you're in a higher tax bracket than in a lower tax bracket, right? If you're in a 35% tax bracket, a dollar of deductions worth 35 cents. If you're in a 20% tax bracket, a dollar of deductions worth 20 cents. But a dollar of tax credit is always worth $1. So that's the most important thing to remember first. Then there are lots of credits out there. A lot of states have credits for charitable donations. Okay. So you might donate to a food shelter and get a tax credit for it. So really what you're doing is you're telling the government of your state, I want my tax dollars to go over here. Because that's really, you're actually, we all complain about how the government spends the money. Well, there are places where the government tells you, we'll let you spend the money any way you want, as long as it's one of these, things or one of these charities that you donate it to. So there are tax credits for donations in a lot of states. The big tax credit right now in the tax law, in the U.S. tax law, is the solar and wind energy credit. I mean, it's 30% of the cost of in solar, for example, 30% of the cost of the panels and the batteries. And don't forget the batteries, by the way. So batteries are 90% of your savings on your utility bill come from your battery, not from your panels.
Wow.
People miss that. They think, well, I've got solar panels. Yeah, but what happens if you don't have a battery? You're just wasting most of that electricity. So you got to have the battery. So pay attention. I'm speaking from unfortunate experience that I've had batteries go out. In fact, I've got one out right now on my solar panels, and our bill almost doubled because the battery went out.
Oh my goodness.
Very important.
Okay. Good to know. And see, life lessons. Thank you for sharing. So those who are getting solar panels, we have solar panels ourselves. We're like, let's look at those batteries and double check that.
We need those batteries.
Yeah, absolutely. Okay. So moving on as we're moving through part one of your book, Tom. So one thing that I was so thrilled to read, and it's actually on page 105 for those who are following along, is about children's education. So you talked about 529 plans. And you also talked about just other strategies as far as like being able to maximize how to pay for your children's education. So enlighten us, sir.
Yeah. So I have pretty strong feelings about 529 plans.
You did, clearly.
I think they're the dumbest thing ever invented. Well, because, all right, so I'm the youngest of 6 children. So I had 5 siblings telling me what to do all the time. And I just rebelled. I just do not like being told what to do. And the challenge with the 529 plan is it's telling you what to do every step of the way. I mean, how do you invest it? What school can you go to? I mean, how much can you put in? What can you do? I mean, finally, they changed the law. So now if you have excess money, you used to have to pull the money out and pay a penalty if you didn't use it for education. Not just pull it out and pay a tax, pull it out and pay a penalty. I'm going, what kind of terrible idea is this? At least now you can roll it into a Roth. So that's good. That's good. You can roll it into a Roth. But there's too many restrictions, and I just don't like restrictions. And I always look at it as, okay, if my choice is get the tax benefit or not get the tax benefit, and that's my only choice, okay, that's one thing. But if my choice is get the tax benefit this way with all the restrictions or this way with no restrictions, I'm going to choose this way with no restrictions because I don't like being told what to do. So that's kind of the difference between like a qualified plan and a non-qualified plan. So a 529 plan would be what you would call a qualified plan, meaning that the government has qualified everything about it, right? What you can invest in, when you can invest, how much you can invest, what you use it for, et cetera.
Mm-hmm.
A non-qualified plan is everything else. So a non-qualified plan would include insurance. It would include real estate. It would include energy. It would include your business. Those are non-qualified plans. And so if you think about saving for your child's education, which I'm a big believer, I have a master's degree. So, I like, went to more school than, most people, would ever contemplate. And my brother told me, don't go to more school than you have to. He has a PhD in philosophy. So he knows. But if I could get a tax deduction for the money I pay my children, for example, and then they can invest in these other things, and they never have to pay tax on it. And we have control over how much we use, what school we go to, all of those things, and even what investment returns we get. I mean, a 529 plan, you're very limited on what investment returns you can get. Why would you want to limit yourself? That's like saying, okay, well, 529 plan is basically an educational annuity. Think of it that way. That's what a 529 plan is. It's an educational annuity. And that is designed solely for education in your state, with all the rules that the 529 come with the 529 plan. I just think, yes, if you don't know anything and your only choice is 529 plan versus not saving for college, do a 529 plan.
Right.
It's like, mutual funds, right? If your only choice for investing is, I don't know anything about investing, so my choice is invest in mutual funds or don't invest. Well, invest in mutual funds. It's better.
Mm-hmm. At least do something.
It's better than nothing.
Yeah.
It's better than nothing. But if you get advanced education like this, like your show, if you get advanced education, then now you can go, well, wait a minute. I have like 3,000 other choices. Okay. Why am I limiting myself to one? When because all I have to do is learn about them. I mean, that's not hard. That's the fun part.
Yeah.
And once I learn about them, then I go, okay, now I can choose which one I like, and I can do it the way I want to do it.
Mm-hmm. Oh, I love it. Well, and you know what, since you dangled the carrot of annuities, what are your thoughts on annuities?
So as I've gotten older, annuities are different, when you get a little older, because I think there are, the concept of an annuity is great, right? It's basically, I get a fixed amount over a period of time. Mm-hmm. There's nothing wrong with the concept of the annuity. Mm-hmm. Of course, the challenge, with an annuity is you're limited in your return. You're limited on when you can take it out. You're limited on what you can do with it. So you still have all these limitations. So it's very similar to a qualified plan.
Exactly.
Mm-hmm.
Yeah.
Right. Now, the worst thing is to take your qualified plan and invest it in an annuity. That is the worst idea ever. Okay. Yeah. And I've actually seen people do that. I'm going, wait a minute. So an annuity is actually a tax shelter, right? You're not paying tax on it while it's building up. Mm-hmm. It's a tax shelter, and you're putting it inside another tax shelter. Mm-hmm. So you're losing all the tax benefits of the tax shelter, right? Because once you put it in the other tax shelter, it loses its tax advantages, and when you pull it out, it's taxable. So you've actually turned a non-taxable transaction into a taxable transaction. It's kind of like -1 times -1 equals +1. So a tax shelter inside another tax shelter creates a tax,
right? And
it's just it's a very bad idea. But annuities, I think there are situations when annuity makes sense. Mm-hmm. If you go, I'll give you a good example. My first wife's mother, her husband had a pension plan, and his pension plan is basically an annuity, right? That's what a pension plan is. And his pension plan, and he got to decide, was it for his life only and he got more per month, or was it his life and his wife's life? He chose his life only and died the next year. Wow. Had he chosen his, and she never forgave him for that after he died. Because she was a lot more poor because he did that than if he'd said his life and her life. So in that case, that annuity, a pension annuity can be really good.
Right.
You know, I
Right.
mean, there are uses. I think there are uses for all the tools we have. We just have to be careful about when we use that tool. It's like diversifying your assets. Okay. So, which I call diversifying your assets, because the whole point of diversification is to not lose money. It's not to
Right.
make money. It's to not lose money. So when do you want to not lose money? Well, you have so much money that all you want to do is protect it. Well, then diversification makes all the sense in the world. But if you're trying to build wealth, diversification makes no sense whatsoever, because you're very limited because of the diversification. It limits your it doesn't just limit your downside, it limits your upside.
That's huge to know. Yeah. Because I feel like, especially, it depends on the audience, right? Who needs this information? And I think what we're always taught as consumers, especially, is like you said, diversify. And it may not be appropriate for specific audiences based off of their income level and what they have going
And
on.
understanding.
Yeah, and understanding.
Mindset.
So thank you for clarifying that.
Yeah. Now, switching gears a little bit again, I don't feel like we can have a conversation with you without talking about real estate. Real estate, as I read in the book, is one thing that you're very passionate about. So, where should real estate be in everyone's portfolio or diversification of assets? Where should real estate fall?
Well, so first of all, I will say, don't diversify. I'm going to go back on that. I absolutely believe that. I am a strong believer of a niche will make you rich.
Okay? Just riches and niches.
Yep, we say that.
A niche will make you rich. So we have 4 asset classes. We have business, real estate, paper assets, and commodities. First thing to do, and we teach this, by the way, to all of our clients, first thing you do is choose an asset class. Choose one. Don't choose all 4, choose one. Okay. Now you may have to kind of funnel through all 4 before you figure out which one you really love. Okay. But choose one. I mean, I've done that, right? I mean, I got my Series 7 license years ago, and it lasted 2 weeks because I hated it. I did a lot of single family homes that lasted a few years. I hated that. You find, what do you really love, and so that's the first thing. And then even within that asset class, what type do you want? So if you love real estate, and I have friends who love real estate, then what type of real estate do you love? The reason that's important is because I can find you tax benefits in every type of asset, any asset class. So actually, the people who get the best tax benefits are in agriculture. Farmers and ranchers, by far, the best tax benefits are in farming and ranching. Why is that? Well, because it's a high risk business. Nobody would do if they had to pay high taxes. So the government says, look, we need food. Number 1, we need food. Number 2, we need shelter, right? Food and shelter. So that's why real estate gets such high tax benefits, because it's the shelter part of that. So food and shelter. The third thing is, we need energy. Without energy, nothing works. We're cold or hot. In Arizona, we're hot. In New York, you're cold, right? And so you've got to have the energy. You can drive your car. You're going to fly on a plane. Whatever you're going to do, you need energy. Well, okay, so we can find benefits there too, right? That's a commodity. Energy is a commodity. So I say first choose it. Now, a lot of people will choose real estate. Why? Because it's one of the easier asset classes to learn. I think it's easier than a business. I think it's certainly easier than agriculture. Nothing's harder than agriculture. And I think it's easier to understand than energy. Energy is kind of intangible out there. I love energy. I actually invest a lot in energy. But it's a much harder asset class to learn. Real estate's there. We all live in real estate, right? So we know, we naturally understand the fundamentals of real estate. And I think that's why real estate is popular. There are certainly great tax benefits to real estate. I will tell you though, you tell me your asset class, I will find you the tax benefits.
Whew. I love that. Oh my goodness. I was just thinking, is that why Bill Gates went and bought a whole bunch of land? I'm like, with the whole
land has the least amount of tax benefits. So land doesn't have a whole lot of tax benefits. It's kind of like, it's actually more like life insurance. Land is a lot like life insurance because it's not taxable as it grows in value. right? You can borrow against it. You can use it as collateral to borrow. So I actually think of land a lot like I think of life insurance from an investment standpoint.
Yeah.
It's a lot like a whole life policy in that I can use that cash surrender value to as security for a loan, and I can always get that loan because it's actually baked into the policy, right? Land is actually quite similar because you ought to be able to pledge it and get a loan from the land as it goes up in value. So, but otherwise, you don't get a tax benefit for going into land, just like insurance. You don't get a tax benefit for your premiums. You get in insurance, it's the money coming out that's the tax benefits. Insurance is more like a Roth, right?
Perfect.
Than a regular IRA. That's kind of the comparison I would make.
Absolutely. Okay. You know what? I feel like I've opened up a whole bunch of can of worms because I'm like, what about this? And what about this? What about this? So since you mentioned insurance and why do we have limited time? So we definitely need to have another one of these, Tom. But with life insurance, tell us your opinion. Because, we talk about life insurance, whole life insurance specifically. So I would love to know your take on that product.
Well, I've spent a lot of years because I've got friends that are really, I've got a lot of friends in the insurance business. And I finally got it when I understood that the difference between whole life and term is term insurance is an expense and whole life's an asset. And it's just that simple because a whole life, as I understand it, more than 97% of whole life policies pay out and less than 1% of term insurance pays out. Well, that means that if what I'm looking for is an expense because I want to maintain cheap, right? I'm trying not to spend more money than I need, but I do need the protection. Right. So it's truly the insurance aspect solely that I'm looking for, the emergency insurance aspect. That's a term type of thought process. And I think there are people that's probably appropriate for. I think that what I like about whole life, and I have a whole life policy, is because to me, it frees up the rest of my assets. So I want to make sure that, like I have a commercial building, I'd like to make sure it's paid off so that my wife doesn't have to worry about that mortgage on the commercial building. So I can then have insurance that will cover that mortgage. And now it's an asset. She can sell it. The only expense she would have would be property taxes, right? So it takes a big burden off, but it also means that I can look at my assets. I'm going, okay, so my family's taken care of because I know they're going to get the insurance. So I can spend all the rest of the assets. Right. And then if I outlive the rest of my assets, I've even got the insurance to go back to. So to me, it's a really nice, safe asset and again, of course, you can accelerate it. And I'm sure you talk about, using it as collateral for a loan to do other investing.
Totally.
I don't personally use it that way. Okay. And I think it's absolutely legitimate use, and it does accelerate. It's what Caleb calls the and asset, right?
Exactly.
Right? And you do these other things.
Exactly.
And I like that. I like that. I think everybody has to kind of look at their situation and say, what's right for me? Because it's like people ask me all the time, well, do I do a corporation or an LLC or a partnership? I'm going, I don't know. It depends on your situation. So let's look at your situation and let's see what's right for that situation, right? Because there's not good and bad. There's just appropriate and inappropriate for the situation. So as I like to say, if you want to change your tax, you have to change your facts. So it's all about your facts.
There you go.
You know what? I'm so glad that we've had that conversation, that distinction, because as we've continued to evolve and our knowledge has changed and life cycles have changed, we've recognized, exactly like you were saying, how do we properly use insurance to be the asset that it is? And so recognizing the fact that first and foremost, what I feel like sometimes people misconstrue the conversation of like whole life insurance or even, infinite banking, when people say like catchphrases and things like that, is like they disregard life insurance for the death benefit asset that it is, and look at it only for like the transactional opportunities that you do have to get a loan. And not to say that isn't a benefit, but first and foremost, like instead of like manipulating the policy in such a way where you get this or that. It's like, again, let's remember, first and foremost, we're buying life insurance, and we have to respect that the asset that it is first and foremost.
Right. Now, speaking of assets, as you were speaking, I swore it was in your book, but there was a visual in my mind of seeing where the difference between a poor person and a wealthy person, and how they prioritize expenses and assets. So there was a box where it had the individual's income, and then the first thing that individual does is they pay their expenses. Right. And then it doesn't get a chance to get over to the assets because they spent all their funds. Right. Whereas on the opposite end of it is a wealthy person who, when they get their income, it goes into the assets first, and then they purchase their expenses.
Yeah. So actually, there's a really good book on that, Profit First, by my friend Mike Michalowicz.
Yes.
Do you know?
Mm-hmm.
Yes. Do you know this book? Yeah, Mike's great. You know, it's a really good concept that, pay yourself first, basically, right? But this is actually so I've known Robert Kiyosaki since 2001. I met him in 2001, and I've been in a lot of conferences where I was the student and he was teaching. I was not up on stage with him. I was a student. I'd say one of the most important things I've learned from Robert is that point, that he and his wife, Kim, they made a decision early on that they would never say, we can't afford it. They would say, okay, what asset do we need to buy in able to afford this luxury, or what we want to do, the vacation, the car, the house, whatever it is. Okay. So, they use their assets to pay expenses and liabilities and they have, and I can attest to that. I've watched them over the years, and it's pretty amazing. So for example, Robert, when he wanted to buy a Porsche, and what he did was he took the money that he saved to buy the Porsche, and he bought a warehouse, and then the warehouse paid the payment on the Porsche. And what that means is that after 5 years, the Porsche was paid for, and he still had the warehouse. So this is a primary mentality difference, that if I buy the asset, and an asset by Robert's definition, mine as well, puts money in your pocket. If I buy the asset and then use the income from the asset to pay for the expense or the liability, then I'm always going to I actually make money by doing what I want to do.
Right. Right.
Oh, mindset. And it's funny what you said, Darius's shirt. I don't know if you can see it. For those who are watching, it says "Follow the money," and exactly what you were talking about. Like that is just such a gangster opportunity, right? I want a Porsche. Let me buy this warehouse instead, because it's going to fund it. And that's definitely something that Darius and I have learned from Robert Kiyosaki, right? If I want something, what asset is going to pay for that? And thank you for that illustration.
Well, yeah. So can I take it one step further? Do we have time for
that? Yes, we have, as long as you want.
Right. So story. Years ago, we were in, Robert and I were in Santiago, Chile. And the sponsor of the event was the Bentley Lamborghini dealer. And there was a Bentley on one side of the stage and a Lamborghini on the other side. And the very first day, it was a 2-day event. We had about 600 people at round tables in the room. And Robert gets up to me and says, I want you to explain how to deduct a Bentley. So I got up and I explained the rules for deductions, right? Business purpose, ordinary, necessary documentation, all that. At lunchtime, this tax attorney from Santiago comes up to me and he says, Tom, that was really great. You can't do that here. It's not legal to deduct a car. It's specifically excluded as a deduction. So that evening, I tell Robert this story, and he just kind of nods at me, smiles. Next morning, we're getting up on stage and he goes, okay, today you're going to show them how to legally deduct the cost of a Bentley in Chile. And I'm going, okay. I mean, I'm like, what do I have to lose here, right? These people don't know me. I'm fine. Whatever. Here's what we did. So we got up and we told this story of the Porsche in the warehouse. So what we did was the $50,000 that the Porsche was going to cost, it was used Porsche, the $50,000 Porsche was going to cost, we put as a down payment on the warehouse. The warehouse, we got a deduction on because it's real estate and real estate produces those tax benefits. Okay. So we got a deduction on the money that we used that bought the Porsche. We didn't get a deduction on the Porsche, but we got a deduction on the amount of money. So the cost of the Porsche, we got a deduction for. We just did it by buying a different kind of asset.
Yeah. Mindset.
There it is.
That's the entrepreneurial spirit. How do I do this? Right? Oh man, that's so good. Thank you for sharing that. And you know what's interesting too, the thing that I wanted to ask you about, which is talking about like moving from an S to a B. That those are some things that we were talking about. Going again back for those of you who are watching from the cash flow quadrant, how do we move from small business owner to business owner? And a lot of these things that we've already laid out is there. But you know, specifically, you had mentioned basically on page 114, you illustrate it very well. So if you all want to go back and look at it, it's there. And the biggest thing that I can say is really just the mindset. And anything else you want to add on that?
Yeah, I would add, there are a couple of other things that I think are very important. If you're going to go from S to B, number one is you need systems, because you cannot be managing people. You've got to be managing systems, and the systems have to manage the people. So that is what restricts most people from going to S to B. And then you can have a much bigger team, because it's systems and team that takes you from S to B. People stay in S because they don't have the team and they don't have the systems.
Yeah. Oh, I love that. Now, the other thing too that I want to try to ask and make sure that I'm communicating it clearly is like, a lot of people might read this book, Tom, and they might say, well, I'm a W-2. And, you know, how do I change my mindset, or how do I create, you know, a designation and an LLC so that I can, you know, start leveling up my tax game? What are some tangible things that you can give to that person who is working maybe a corporate job and trying to figure out like, how do I really,
where do I even start?
Yeah. Where do I start?
Well, the terminology in today's vernacular is it's a side hustle. That's what it's a side hustle. So that means you're starting a business on the side. Now, actually, and I walked through this in Win-Win Wealth, the government will actually pay you to start a business. So literally, the tax benefits of starting a business are greater than the cost of starting a business. So if it takes you $10,000 to start a business, it's pretty easy that the tax benefits are going to be more than $10,000. So it's free. It's free to start a business in this country. It's literally free to start a business in this country. So
there's
start a business, but it doesn't have to be, you know, it could be an online business like Amazon, or it could be something like real estate. You know, go buy duplex, live in one side of it, right? I mean, really simple stuff. Have the mortgage, have the renter pay for your mortgage, and then you live free, right? Then you buy another duplex, then you do another, then another. Start small. It could be, I'm going to go invest in some solar panels, right? Doesn't have to be a big investment. I know people, I know you can actually invest in oil and gas for as little as $10,000. You can invest in, obviously, insurance. I mean, one of my favorite uses of a whole life policy is I don't have enough money to make a big investment. Now, if I'm making $100,000 a month and I have $100,000 a month to invest, it makes no sense, frankly, for me to put that into a whole life policy and wait for 5 years before I can actually pull it out. I'm just going to go invest that money. I'm never going to make up that 5 years.
Right.
Okay. But if I've got $5,000 a month, I can't go do that investment for $5,000. So why not put it into that whole life policy and have it grow in that whole life policy? And then when I have enough in there that I can really do a real investment, now I can go and borrow from the insurance company and use that money to do that investment. But it's working for me in the meantime. So I think that's a time where using it as like your own bank, in infinite banking, that thing, that's where that really makes sense, is when you're in that awkward level where you're saving some money, but not enough. to do anything significant.
Yeah.
So you know, better to save it where you're actually making money on it than save it in a bank.
Right.
You heard it here, folks. Now, okay, so I want to know this, Tom. Can I deduct a loan? No. Hold on. Mindset. How, Tom, do I deduct a policy loan?
Well, you're not deducting the loan. What you're deducting is what you do with the loan.
That, yes.
Okay? So again, we're going to shift. It's the loan itself is not deductible.
Correct.
Right.
Correct.
You have to actually use it.
Yes. Yes.
But if I take that loan and I invest it in, basically, if you think of it as hard assets, hard assets typically come with tax benefits. Hard assets like
real estate,
business, commodities. Those are hard assets. You put it in paper assets. Those are not hard assets. You don't get a deduction unless you're doing like a 401k. That's the only way to get that deduction. So I can, I can deduct that. Now, here's what's cool about this. So the other thing I get to do is, while the cash surrender value inside the policy is building up, it's building up tax deferred or tax free, depending on when it comes out, right? And so it's a deferral to permanent, what I call deferred to permanent. And so it's doing that, but at the same time, you actually get to deduct the interest you pay the insurance company if you put it into a true investment. And the reason is because the way the tax law treats interest is on the use of the funds, not the source of the funds. It's the use, not the source.
Yes.
So if I use it for my business, I get a business deduction. If I use it for my real estate, I get a real estate deduction. If I use it for energy, I get an energy deduction, right? So it's really how you use it, but then I get the interest deduction too. It's not like a 401k. A 401k, you're actually borrowing that money from your 401k.
Yes.
You pay interest, you're paying interest to yourself. You do not get a deduction. In the insurance case, you're paying interest to the insurance company. All you're doing is using it as collateral. You're not actually borrowing from your insurance policy. You're borrowing it. You're using it as collateral for your loan. That's it.
Yep.
Okay. So it's a very different. It's really something that's very different than, say, borrowing from your 401k. That's why that interest would be deductible. Now, if you take that money and you use it for a vacation, no deduction.
Yeah.
Right. 100%. Now here's a real life example that I want your opinion on. Is we have a client that has life insurance policies, and she borrowed the money to purchase houses for the children. The children paid the parent back interest only loans, so they can deduct those because it's interest only, and they owe the money back for their mortgage per se. What is the structure that there should be in order to make sure that the proper documents are prepared?
I would sit down with your CPA and make sure you go through that very carefully. That is not something to do on a podcast. Now, is it possible? Yes. There are some downsides to that, by the way.
Okay.
Don't ever ignore, it's like, the side effects of the drug, right? Really good for this symptom. You may die from it. Okay. So there are side effects from doing clever things like this. Okay.
Right.
This is what I would call a clever thing in the tax field. And the biggest one is they lose their $250,000 exemption because they don't own the house. Okay.
They don't own the house.
If they bought the house for them. Now, if they just loan them the money, that's fine. So in my opinion, take the money, lend it to your children, have them to buy the house. Okay. That's fine. Okay. But actually buying the house for them, that's not, I think, so it's just, how do you set it up? I would rather have them buy the house. First of all, if they buy the house, they get their credit score goes up, right? There's all sorts of benefits. You're looked at differently in the world. In the U.S., you're a homeowner. You're different, right? You have stability, right? Because you're a homeowner, and basically you're basically lending them perhaps the down payment for it. Okay, now that income to you, that interest income, is what's called investment income. And investment income allows you to deduct the investment expense on Schedule A of your tax return.
There we go.
Yep. Gosh. And you know what? This is a perfect example where you even spoke about it in the book. It's like you don't do anything until you understand the tax implications of it first, and then you pull the trigger. And again, another mindset shift, because how many times do we just go make the purchase, do it, and then we go, hey, by the way, how does this work with taxes? So that a perfect example of that. So thank you. Now, one thing as I just...
Oh, you were going to say something, Tom.
I was just going to say, this is another example. Don't do it by yourself. Okay.
Right.
DIY, really, really terrible. Don't do it yourself. Make sure you have a tax professional alongside you, because, we're talking about some generalities here.
Mm-hmm.
You can get in a lot of trouble with generalities.
Yeah.
I would never, do surgery on myself. Right. I mean, what a bad idea. I mean, I can hire a surgeon. Frankly, I don't fix my roof. I can hire somebody to fix my roof. Right. I'm a big believer in specialists, and taxes are probably the most complicated aspect of law is the tax law. Mm-hmm. So while it's very important that you understand taxes from a general standpoint, you understand what's possible. Mm-hmm. It's equally important that you have a good team member on your side, a good CPA who will actually help you do all the details and, make sure all the I's are dotted and the T's are crossed.
I love that. Now, one thing, Tom, that I was just thinking about with going back to the policy. Say, for example, I have easy numbers. Let's say I have $100,000 outstanding loan balance in a policy, and I have a windfall of $100,000. How do I not claim income on that windfall? Can I pay my loan back and reduce my taxable income?
No. What you would need to do is you'd go buy the asset, right? Oh. So what you do is you go buy the asset. So you go buy that real estate, energy, et cetera, have the income from that asset, pay the loan down.
There we go.
Thank you. That's all I needed. That was real life, by the way. There you go. Thank you for that. Fantastic.
Go. Yeah. So we've been vibing on the right track.
Yes, absolutely.
Yeah,
I would say that. Now, Tom, one thing I would like to ask you, I mean, you've given so much information and so much time. Thank you. That the next thing that I can imagine for the viewer is like, how do I work with somebody like Tom or his team so that they can help me with my taxes? Do we have access to you, sir? Well, not you, but your team.
Yeah, actually, we are just opening up our monthly webinar. It's actually twice a month, and you actually can get access to me for drum roll, $97 a month.
Oh my gosh!
So this is we have literally never opened this up to anybody besides a client before, and it's just education and ask your questions, right? So it's all education. But we do also have a franchise of CPA firms. So we're the first CPA-based tax advisory franchise. It's called TFW Advisors, and you can go to tfwadvisors.us. And it's new. Our first franchisee has been with us less than a year, and nice. We have 9 franchisees around the country. And these people I've known for several years. They've wanted to do this. They've been bugging me to do this, and we finally kind of decided, okay, we're actually gonna do this. When I announced it, the first thing I get from one of them is best idea ever, and which was great. I kept that text because I'm going, that is awesome. This is somebody that I've known for years and years as CPA, mm-hmm. and one of our franchisees. So that's if you want to work with one of our franchisees. That's the way to do it. But you can also, we have education and everything through our Wealthability company.
Mm-hmm.
Yeah. Fantastic.
And it's a lot of information in the Wealthability, from taxes to wealth building.
Mm-hmm. It's so powerful. And Tom,
I was doing a real estate one yesterday.
Yeah, we were all in it. The other thing too, Wealth Nation, it's just important for you all to know, like we always say, own your own lifestyle, right? Wearing the shirt today. And what Tom really does is he allows you to take ownership in your tax journey so that you can ask the right questions, so you can be better prepared, so that you can reduce your taxes as much as you possibly can. This is attainable, folks, and you don't have to rely on your CPAs and whatnot to do it. This is very much going to be a collaborative event when you take ownership and you understand what you can do. So thanks to Tom Wheelwright, he makes that information so accessible and tangible for us to do. So thank you again, Tom. Is there anything you'd like to leave our viewers with? Any nuggets that came from our conversation, or just something that you want to make sure that we empower our audience with?
You know, I love that you want to empower your audience, because that is actually our mission, is to help people become financially free of employers, Wall Street, and the government.
Hey,
and that is our mission. So what you're doing, I applaud what you're doing. Your taxes are your single biggest expense, and they actually have a bigger impact on your wealth than any other aspect of your life. Okay, a bigger impact on your wealth probably than your job. You know, here's the way I put it. If you invest like normal people do, 2 + 2 = 4. You can double your money every 7 to 10 years. If you use leveraged debt like you do with your life insurance, 2 + 2 = 8. But if you get the tax benefits, 2 + 2 = 16. It's the biggest leverage you've got is the tax law.
Love it. Thank you, Tom. Thank you so much. And remember, family, if there's anything that we can do to support you, we are here with you. We are going to leave all of the amazing links below so that you can have access to all of Tom's resources and his team and books and things that we referred to. So remember, Wealth Nation, own your own lifestyle.
Or someone else will.